that picture for 2025 is very dependent on the labor market for the US, as you say. Ollie, maybe, coming to you because for the European market, actually, we've seen quite a softening in the labor market so far. So, is that a potential source of divergence, I guess, between the central banks going into next year?
Yeah, I think that's one part of the divergence we're seeing, and one of the reasons why we think the ECB will and also should be cutting quite a bit more than markets are pricing. So if we look at it, of course, at the headline level, unemployment is basically at a historic low. We have employment growing at a rather solid pace. So there's hard to say that there has been much labor market damage. We have talked a lot in the past about labor hoarding, where firms basically kept more labor than they typically would. And overall, kind of this fed into wage pressures. But if you look at the underlying numbers, I am not so sure that's really the right way of assessing the European labor market, because if you look at real earnings, they're actually still below pre-pandemic levels, which is a big contrast to the US, where it's clearly above pre-pandemic levels. So the outcome is really for us more that workers have struggled to regain their bargaining power, given that, yes, labor markets have been solid, really quite resilient, despite all the headwinds from monetary policy, from fiscal policy, from the big energy shock. But in the end, what really counts, I think, is real wages, and those have been rather poor because workers haven't been as strongly, haven't seen their bargaining position as strong as some suspect, given the low unemployment rate. So we think some of the fall in the unemployment rate is really more structural than rather than cyclical. Now, moreover, on top of that, what we have is really a slowing in terms of hiring intentions. Really the feed through of tight monetary and fiscal policy. There is likely to be something like a stagnation in employment growth, broadly speaking, over the next couple of quarters. And this is despite our assumption that the labor force will be roughly stagnant or maybe even grow a little bit. So there might be a bit of a rise in unemployment, but certainly we don't expect big falls anymore looking forward. And maybe the biggest factor really when we talk about the outlook for inflation, especially, and the difference to the US is a lot of the labor market wage agreements are really in a way indexed to inflation, and inflation in Europe is certainly below 3%, heading towards 2%, and in our forecast even below 2% in parts of next year. And this really means that nominal wage growth is going to go lower. And that, I think, is one of the underlying currents that will drive the ECB to respond eventually. But it seems they really want to see those signs rather than wait for it.